All right. Good morning, everybody. We still wait, and we still wait. I did share a an image taken from Spot Gamma showing that the call wall and the put wall have moved it down together. That is a clear bearish bias. Take that with a grain of salt. The market can position for a bearish outcome and still not get one. Also, it's if you watch or read Spot Gamma's founder's note, often they will talk about how the algo or their tool will just search through the options chain for the next day's expiring options and look at the notional value of the strikes that are listed. That's why on a day-to-day basis, options that are closer to expiration, when their notional value changes in that overnight before the next day, when we come in today, the numbers can be radical or extreme, and we can get a significant change from one day's event to the next. It doesn't necessarily mean that new positions were put on or that options were rolled or moved or changed in any way. We use the phrase rolled because they moved, right? And a lot of times that happens because market participants go in and actually change their location, and they did roll those positions. But when these strike levels move, the call wall and the put wall, it doesn't necessarily always mean that a position was moved. It can simply mean that, yesterday at the close, yesterday's 0-day options are gone. They're no longer there. We would default to today's options, which would become the 0-day options. And whatever notional value that is highest will now become that call wall and that put wall. And it does not mean that some new position was made or that they got more heavy, bearish, or bullish or anything like that. Not on its own, right? Of course, they could have gone in and traded heavy and built these call walls or put walls yesterday for today's close, right? They could have rolled yesterday's positions into today. They could have built them. My argument is to just be mindful that they don't by default mean that somebody built them for today or that, that they were rolled as an actual position. So just be mindful of that, right? The institutional language that we use, like rolling, and by institution, I mean, just the staple concepts that we use, like rolling, doesn't necessarily mean that somebody actively rolled down these calls and put walls. Anyways, it does project a bit of a negative bias to see that the current positioning is more closely, how do we want to say this? It's the ceiling got a heck of a lot closer. I think that's just about sums it up. And the pit got a little bit deeper. The UK is up more than 1%, and Hong Kong is flat. Japan also flat, small caps right behind it, but in the green. NASDAQ, S&P, and the Dow all just hanging out as we have been, waiting on data, waiting on something. So as you can see, we're just in this topping pattern. right? We got to get out of this box. Now, in a topping pattern, it does imply that we've reached some sort of plateau and that's it. You know, we're going to crest from here and roll over and go down, but we don't have to do that. If we back it up, you know, to this topping pattern here, we pulled back just a wee bit, retested that top, and look how long we maintained this structure of really just doing nothing before we finally continued on. So yes, we've had a phenomenal run since the April lows, and the capitulation and the bond vigilantes came in and ran it back in the other direction. All true. But that doesn't mean that we're done yet. And a lot of the positioning that we've seen shows that we've got a lot of room to run still. There's always bricks in the wall of worry to cause concern and make us believe that, you know, this is it and we're headed down. But so far, we don't have that signal. We're still holding above the volatility trigger. We're well above the 10-day, the 3-week, 0 gamma. All of those are still below us. So we're still maintaining our structure. And sure, the call wall is a lot closer to us than it was, but we don't know if that's a 1-day thing. It's in the middle of the week. We're not at OPEX. There's a lot of reasons to believe that this current call wall is transitory. You know what? I think they should just retire that word. It's probably temporary, and it's going to be somewhere else by tomorrow. What we want to see is a call and a put wall that get lodged into a particular spot for a while, and that it's dominant across multiple expirations. That would be a more solid level to pay particular attention to. Last week's high is still the level of interest that we need to dominate. And so far, you know, we've been unable to do that. And we have this week's low as the range that we want to focus on, those two. So last week's high, this week's low. If we break our own low on the week, then we'll focus on last week's low, right? And then we'll broaden the box out. But that's if, right? Otherwise, we would be focusing on a much wider range that doesn't deserve our attentions, right? We would be using 62.20, which is another 20 points down here, closer to the 3-week moving average. The volume's still coming in a little light on the week. All things considered, it's either a part of this hurry up and wait mode that we've been in, or it's still the market just acting in its summer doldrums. And it's possibly a little bit of both. It's always hard to prove a negative. So when we're looking at a low volume like this, and we just don't have a takeaway for it, the best we can do is just recognize that, hey, the volume is still really light, participation is still really light, and the markets are still waiting on something. We still don't know what that something is. On the week, we're still IX10. If we were considering, like we were talking about in Microsoft yesterday, that this may end up being something like an evening star reversal, then keep in mind that is a multiple candle pattern. And this is a weekly chart, which means we need multiple week closes for that pattern to unfold. It wouldn't happen on a day-to-day basis. We're also looking for the big tells on the weekly chart, which are big gaps. A big gap is either really bullish or really bearish, depending on the direction. But we want big gaps up off the lows and big gaps down off the highs. Otherwise, if you're looking for a reversal, do it the other way around. Because if you get a big gap down on the lows in the indexes, a lot of times that's your long signal, right? You get the big gap down on the wrong side, and it makes a really nice play for the other direction. So we're up. We didn't get a big gap this week. If we're looking for that evening star reversal with a gap, then it would be the next candle that comes into play. And the close of that gapped candle should be, like 61 or 6100, maybe even lower into the 6050, into that 10 or more. Because if we can get a leg out, like a rally base drop leg out, then that would be just a really clear setup. A bit like this. So we're going to get a little bit of jobs data today. And we've got auctions in the front end. It's the 4-week. You could just go ahead and use the IRX on that. And then we've got the 30-year. We're not supposed to have favorites, but I do pay particular attention to the 30-year. I like it. We got some Fed members chipping their teeth throughout the day today too. 10 o'clock, 1 o'clock, and 2:30. We're not expecting them to say anything that they haven't already said. They're all beating the drum. They're all saying the same thing. And so far, we're not expecting that to change. We keep looking through the economic data for whatever it is that the market's waiting on. And it may just be that the market's waiting on the tariff stuff this week, right? We was talking yesterday how the deadline moved to August 1, and yet we're still getting a lot of tariff headlines. Whatever it is that the market's waiting on, it's not showing up in the calendar. And if you look at the founder's note, they've got the jobless claims today as one of the volatility triggers that they've been monitoring. But the next data point is July 15th with CPI. Right in front of earnings, too. So that's a whole other week away. And we've seen the markets do this hurry up and wait for 3 or 4 days. I can't imagine it doing a hurry up and wait for an entire week and a half. So at this point, GTFO, we got to get out of the box, start with the Globex range that we have right now. Getting through our Globex high gives us a chance to challenge yesterday's high and then get to the ADR half. We can get to the ADR half on the downside without breaking Wednesday's range if we focus on all of Wednesday. But if we're just looking at the RTH of yesterday, we're going to need a break out of that to get to the lower edge. Still, at this point, we're basically flat. So we don't have any edge to get to one side or the other by the end of the day. And today's floor pivot is basically resting on top of the weekly floor pivot. Today's pivot's higher than yesterday's. That's considered bullish. Price opened above it, and that's also considered bullish. And we've already come down and hit it, so we don't have an MDP, and we rallied back above it. So we're not even owed any sort of a pullback at this point because it's already taken care of that. What this is doing is setting us up for a really nice move to the upside today because it's already taken care of all of its obligations to the downside. Now, we don't have to break out. Price doesn't have to do anything. But if the market was waiting on the minutes to provide something, we got those minutes. It didn't change the game. And after we get jobless claims this morning, which should not come in with a surprise, then we should be free and clear to do whatever we want for the rest of the week. Yeah, no discrepancy here. So unless they scratch and come in really far off, we shouldn't have any real issues with the job numbers today. They're not projecting any issues. All right, we did get a little bit of a range expansion yesterday, which broadened out our SNR levels for today. You can see really clearly how when we have a narrow day like Tuesday, it gives us a narrow range on the SNR levels, which we see on Wednesday. But Wednesday, we expanded more than we did on Tuesday, and now the SNR levels are much wider. Getting to R1 or S1 would be the base case. So if we can, tag an R1, that can offer S2. But if we get to R1 and get above it, close above it, then it opens the door for R2. So we made it out of the value area. We're still not developing a new distribution up here. Instead, the entire thing is filling out. right? So, we're not doing like we did here where we had two different distributions and a real shallow area. Instead, we're just filling in the whole thing. So I would look for the value area high on the week to move up. Maybe see a shift in the point of control if we hang out in one spot for a little bit. Say if we stall across the high or something like that, it may move that point of control up. So then it would, start to develop like last week's, but in reverse, right? If we were to take this whole thing and flip it over where the point of control was up here and this distribution was down here, that's what it would look like for this week. We would just need to get across this high and then stall out there and bring that point of control up. Why it matters is once it gets rolled up to us or brought up into that 63.20 area, it can act like a zone where we can see price just hang out here. And it's already Thursday, and Thursday's half done already, right? Which means if we get it up here, we could just stall there for the rest of the week and not do much of anything, go into the close. Markets would see that as happy, a bullish, a continuation of the exuberance that we've been having, and the talking heads on TV would all be exclaiming that, the market's still up. It's another bullish week of blah, 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 blah. It fit the narrative, right? Ten-day, 30-minute volume profile with TPO, the point of control matches on both of these, but look at the narrow distribution in the TPO. We've got the value area high and low just really tight on this range, and it's what we're expecting out of the volume profile by the end of the week. Really, I kind of thought we'd be there already, right? Yesterday, I'd mentioned that I thought this would be rolled up already and that it would be somewhere in this and it would match the TPO's levels. That hasn't happened yet. Also, it's worth noting that, we're really close to seeing the point of control move up into that 62.80 area. Today, tomorrow, it's very likely going to happen just by default, and more so if price can come back down into that level one more time. If price comes down into there one more time, we get it moved up. Otherwise, we need to mark out a couple more days until we can get into these candles and take that volume off the table. Then it'll move up by default. If we come down into that level and move it up on our own, the threat becomes that we can leave that zone to the downside, and now we have it over our head like a resistance level that we later have to work through. If it gets rolled up by default of elimination and we're above it, it's still sitting underneath us as a structural level of support. No new VPOC for today. We crossed that level multiple times already, so no value there. The TPO and the volume profile this morning, they're matched up really nice, so no surprises, no outliers. The one thing that does stand out is the value area on the volume profile as opposed to the value area on TPO. Looking at the 10-day and our distance from it, we're still above the 10 and near that 1% mark. This is a really good place to be. If we're looking at, how's the state of the market out there, this says we're doing fine. We're not overbought, we're not overextended, we haven't moved too far too fast, and it doesn't owe us a pullback. Imagine that, right? Because that's what everybody keeps telling me is, well, I don't want to buy these levels. We've already ran too far. This says we haven't. Now it's on the daily. We can get a little perspective. When we look at the weekly, because this is where it really does show that we've run a long ways and we've gotten a little ahead of ourselves. Leaning out over our skis is the phrase I've heard multiple times this week. We've been higher than this, and all we're measuring here is our distance from the 10 week, right? The 10 week is often a cheat sheet for the mean price, the average price. If you want to use another word, fair price, doesn't really fit into futures, but either way, it's basically a generic mean. And when we're this far away from the mean, the fear is mean reversion. Every market's got a different relationship with its moving averages, and you would probably be better off calculating a mean, but most people just use the 10 week. Right? And with this, sure, we're more than 4% above the 10 week, but we were farther away than that. And we didn't come crashing and burning back down to earth like we have when we've gotten overextended before. We've been gradually working our way back, which is a more healthy return to the norm. So we're looking to see this continue to ease off of the throttle and just either sit and let the 10 come to us, which is called a correction in time, or we actually just go ahead and correct in price and get it done and get it over with. Obviously, if we correct in price, it'll get done faster and we can continue to do whatever it is that we wanted to do, be bullish or be, stagnant, whatever. We're not stuck waiting for the market to heal. This whole week, we've been hanging out underneath Friday's close. And if we're using OCR type analysis, if we look at the lows, they're higher lows. So we're building a wedge of compression here. It doesn't really feel like it because of how wide Monday was, and then another wide day yesterday, but we are compressed. Not a great example of compression, but it is compression. Also, this is like a micro TRB, and that owes us back to the top, which is that Friday close. Then there's trader's remorse, a liquidity gap. There's a lot of ways to see this, especially with the drop that we have here. And that is a gap. I know a lot of analysts won't call this a gap because, we're still in the range of this bar. But from a day trader's perspective, which is what a lot of analysts don't do, we closed there and we opened here. And dang it, that's a gap. And that gap is still there until we get back to that level. That's the way I do it. Just because I do it that way and other analysts don't doesn't mean that I'm right and they're wrong. It's just a different approach. So we've got a gap to close. And if we get close to it, we're very likely going to begin to gravitate into it. That'd be one piece. The other piece is, okay, well, when we do get there, then what? Trader's remorse has to be a part of that conversation. If you got into trades to go long on a Friday, and then we dumped on Monday, Tuesday, Wednesday, Thursday, we're still not at your position, and we finally get back to you Thursday afternoon or into Friday, what are you going to do with your position? Now, I know everybody's different, but I've seen traders do some really silly stuff, including bag holding losses for a ton of loss just to get back to where they started and bail out without getting any extra profit out of all that pain. They were just happy to get out. I would not be surprised if at least first touch comes into play when we get back to Friday's close, which will make for a really nice trade on a first touch play. It's like a 111 or a 1-2-3-6 rejection first touch play. We've got Bitcoin down this morning. And really that's all we have that's down this morning. But it's important. I know a lot of people just poo-poo on Bitcoin and say, it's junk, it's worthless, blah, blah, blah. Yeah, maybe. I'm not asking you to, love it and own it, but you may want to keep your eye on it because it is a really good tell for risk and risk appetite. If they're not interested in taking risk, then we'll often see like a rotation in capital back into staples or a flight to safety, those sort of plays. So it's worth keeping your eye on Bitcoin. At least use it as an indicator. Okay? So looking at what's up this morning, gold miners are close to the line. They're not there yet. Same with uranium. It's moving in the right direction. It's just not there. We got some China stuff that is near the line, some that are above the line, but that's like a triple X China. Chips are up this morning, 0.5%. Take it. Having China up is one piece of the puzzle, but I would want to see China up with Bitcoin. Those two combined make a nice tell. Just having one or the other doesn't quite do it, right? It's like saying you have a Porsche motor. Yay, you got a Porsche motor without a Porsche car. It's not going to do you much good, right? So you get China up or Bitcoin up. Yay, you got one part. You kind of need both parts. Jets, we've had a heck of a run in the last few days with these guys. It's another example of a sector or an industry that's junk, trash, but there's a lot of good airline plays that are they're just fun short-term day trades. They're cheap companies with relatively liquid options. So, worst comes to worst, we'll play some airlines today. Pot stocks are up this morning, but I mean, they are a joke, right? And that hasn't changed. We are back to the year-to-date anchored VWAP, or we're really close to it. We haven't managed to stay above it this year, right? There's the start of the year. We winked up there and failed. Same thing again. Third time's a charm. Maybe. I've got a lot of this that I've had for a long time. And the only reason that I'm not negative in it is because I've sold options on it. But my position isn't wow, right? Because look at this thing. Broken down, and it's going to stay that way. These little bumps to the upside don't matter for anything, and it's not going to change until legislation changes. If you guys remember during the presidential election, whenever Harris was talking about legalizing the marijuana space and just really putting in a lot of effort in this space, it would get bid up. But after she lost, it took a significant beat down. So we're not looking for this to change anytime soon. Legislation has to change. These little plays are just something to do on the day when there's nothing else going, right? But if we can get above the year-to-date anchored VWAP, we can get reciprocation on the other side. So however deep we went one way, we can get to the other side. Just measure it and plot it the other direction. But not likely to happen, really fast. It's going to take a while to get that sort of move. Silver's got a lot of work up here just building out that cluster. For a long time, getting through 31 and keeping it seemed to be the chore that it just couldn't do. Now we got above it, and 34 is the new level, right? So we've got 32 to 34. That's the channel. We got to get out of the box, get that run. And both of these have been acting weird, right? Gold and silver, they've been a little off the last 4 or 6 weeks. I would watch those precious metal plays with the dollar making this move back up. So we've got a relatively decent start. We got chips, precious metals, a little bit of China. We want to see more China, and we want Bitcoin to get in here, and preferably some Mag 7. Zero-day flows could start to kick in after we get through the open. And I shared this image yesterday. See if I can find it. There's a lot of times when the market's moving, we're trying to answer that question of what's moving the market. Sometimes it's options flow. Sometimes it's treasuries, right? We just never quite know. So when we look at that move yesterday, when headlines dropped the market, we can see the S&P fell out, US dollar Japan, US 30 with JP 30. Both of those fell out, but the buy right monthly index didn't fall out during that move yesterday. Right? It wicked down and it came right back up again. This is yesterday. It's hard to see because this is where it opened. And then this is yesterday's price action. All three of these charts are on a 5-minute. So look at the buy right yesterday compared to something like the SPX yesterday and this 30 ratio over here. If it was options that dropped us yesterday, we would have seen either them leading or at least matching the other two charts, because all three of these generally move in sync. And we didn't get that, right? So it wasn't the broader market. And during that drop yesterday, that was actually a wrong time frame. During that drop yesterday, the broader options market didn't even price into it. So we had that sell off. They did not go out and start buying puts in like Apple, Microsoft, Meta, right? The Mag 7, the broader market. They just didn't run out all scared and start trading up short. The options market, little bit of a speed bump, and then it completely ignored that drop yesterday. So keep your eye on the options market today. If we get this breakout, see if they start pricing that in for a continuation to the upside, because they sure wasn't pricing in that drop yesterday. They didn't facilitate it or get scared. No flight to safety, nothing. Maybe a hard thing to look for a breakout to the upside today with Bitcoin down that much. So maybe one of the tells to look for today, Bitcoin doesn't necessarily have to turn around and run, but not falling anymore would be a really helpful step in the right direction. Otherwise, if we don't get a breakout today, we could just sit sideways. It doesn't owe us a breakout. But the range has already started to expand, with Tuesday being the sideways day, Wednesday starting the expansion. We're just looking for the continuation of the expansion at this point. If we get our breakout of yesterday's high, then we've got 63.22 as the 111 and 63.32 cog line as the 1236, and it lines up really close with last week's high, that Friday high. Cool, cool. Otherwise, if all of that rejects, we'll aim for the half, and then we'll aim for the low, and then a 1236 out the back. Simple as that. Everybody, be careful, be safe. I'll see y'all tomorrow. And yes, I do the morning briefing every day that the market's open.